For the end portion of technical analysis, I want to cover Elliott wave analysis to an expert level, not a master level. This is a very deep level of analysis that there are multiple books on, and it would be hard to cover all of it in one course unless it was like 8 hours long. But we're going to cover enough that you can start to do Elliott wave analysis and start to look for the setups that can actually lead to tradable outcomes, right? So the other things that you need to know for Elliott wave analysis right off the bat, this is not a system that works with new IPOs or small cap stocks. This system of analysis is best with larger cap stocks that have some time on the market. You want more than 1 or 2 years. It cannot be applied to every chart. You have to look for the appearance of it. So don't ever be caught trying to force Elliott wave analysis on a chart where it doesn't really make sense, okay? This is an art, not a science. When we go over this, we're also going to go over some structures. We're also going to go over how to utilize Fibonacci levels, also some customization with Fibonacci levels. And the main way I use this as a tool is I'll do all my research, right, to get my idea of like the macro view of things, right? And then I'll kind of build a narrative in my head of like, this is what's going on in the world right now, and this is the way it's going to play out in the market. I'll then go and look at a longer dated chart, maybe like a daily chart or a weekly chart, something with a multi-year time frame. And I'll use something like Elliott wave analysis to see if my views can be reflected in the price action of the market, and I'll be kind of like charting from right to left rather than left to right, where I'll be looking to see where are we going next and what are the high potentials or the low potentials, and to look for those outcomes and see what I see on the chart, and then try to marry that with my fundamentals so that when I'm trading the daily movements, I kind of have in the back of my mind what is coming next and what we should keep an eye on. Or just in the more simple terms, when I'm looking for a swing trade, it can also help me spot what highs I want to look for, especially when a stock is breaking out to all-time new highs. There's no key levels to go off of. And in those cases, I'm going to whip out my Elliott waves and I'm going to whip out my Fibonacci tools to try and measure those movements. So let's go ahead and dive into Elliott wave analysis. Elliott waves are a method of analyzing cycles in a market. The theory is based on identifying patterns in the stock market to identify when the cycle may repeat. The goal is to forecast future market movements, and in this theory, price movements are categorized relative to the larger trend, okay? So it's comprised of motive waves, which is moving in the direction of the larger trend, and corrective waves when prices are moving counter to or against the larger trend. So here we have the motive wave, the corrective wave, the motive wave, and obviously this is a bullish trend, right? Overall. So you're going to try to use tools to try to say what is the most likely pullback we're going to see before we get the next motive wave. All right, so for this, it's important to recognize that there's different patterns that persistently appear in the market, right? We have the classic zigzag pattern where you're going to get what we're going to call an ABC. There's a flat pattern where the market's just chopping sideways. And then you also have your triangle. Triangles are beautiful when they appear because this is the most frequent outcome you're going to see with triangles over multiple time frames, where you have this this kind of wedge that appears on the market, and then you get this A, B, C, D, E pattern within the triangle, right? And those are great if you're not using Elliott to play the breakout of, right? And this is one of the few for Elliott waves that's built off Elliott waves that can be applied even on shorter time frames where you see these wedge developments. The stock has a breakout, and you can do a quick scalp right there on the breakout of it. So the basic cycle structure is idealized as an 8-wave structure, right? The combination of a motive and corrective wave is the general structure of a complete Elliott wave cycle. The motive wave for the classic cycle is a 5-point impulse pattern, and the corrective wave is a 3-point zigzag correction. The Elliott wave theory is built off the repeated nature of this 5-3 structure. So these 5-3 structures are what you're going to look for in Elliott wave analysis. However, they can get more complex. Okay, so this is what we're going to cover is the classic 1, 2, 3, 4, 5 pattern that we're going to see. Once we get to the charts, you're going to see we see this over and over and over in markets. And then what we usually see afterwards is a classic A, B, C retracement to the downside. Okay. And as we can see, we had the 1, 2, 3, 4, 5, and then we have the A, B, C, and then we have another similar 8-wave pattern. And all of this is actually within a greater 1, 2, 3, 4, 5 pattern, right? So there's different time frames that you can utilize this structure on, right? You can go to a monthly chart, you can chart the 5-wave pattern. Within that, there's probably multiple sets on daily charts of smaller 5-wave patterns. The key to getting the highest accuracy when you're utilizing Elliott wave analysis is charting all the sub-wave patterns, right? So this is the greater pattern right here, the 1, 2, 3, 4, 5, and identifying like where this 3 should end up is going to be done best when you are also charting the 1, 2, 3, 4, 5 within it, the pattern within it, right? Okay. It's okay if you're a little fuzzy. We're going to break this down further, okay? And so we're going to break this down to 5 rules, and we're going to focus on the 5-wave pattern, okay? Because the 5-wave pattern is going to be the pattern that you want to trade into. The 3-wave corrective pattern that completes the 8-wave cycle is something you want to be aware of, but it's really difficult to trade that unless you're using some of the other technicals that we went over as signals, okay? So for the 5 rules, remember, you're looking for the 5-wave pattern. It should have 3 motive waves and 2 corrective waves. Wave 3 should never be the shortest wave. And ideally, it's a 1.618 extension, okay, because that's the most common. Wave 2 and wave 4 should be opposites. If wave 2 is simple, wave 4 should be complex, all right? And vice versa. Wave 2 cannot retrace a new low from wave 1, and wave 4 cannot retrace into wave 1, okay? Extensions and retracements often align with key Fibonacci retracements and extensions, okay? So the Fibonacci levels are going to be key for identifying where the waves will end up, right? So let's do an example here. So we have this pattern right here. This would be wave 1, wave 1. This would be wave 2. This would be wave 3, wave 4, and wave 5. But why does this not work if we're using our rules? It does not work because we can clearly see that wave 4 has retraced into wave 1. That cancels out this 5-wave pattern. All right, now let's do another one. Let's look at this example right here. So we clearly have wave 1, wave 2, we have our wave 3, our wave 4, and then our wave 5, right? So why does this not work though? And that's because wave 3 is the shortest wave. So if you get an outcome like this, it likely means that you've charted the wrong pattern. This is likely the wave 1, or this is a wave 5, and you need to redo it. Wave 3 can never be the shortest wave. And it's really important to get your wave 3s correct, because if you can properly identify a wave 3 before it forms, or even better, if you can identify a wave 3 within a wave 3, those are often the biggest moves. A wave 3 within a wave 3 is a massive impulsive move that will be really quick and usually have the biggest movement and lead to some of the biggest trades. And that is also aligns with the TTM strategy we talked about. That the TTM signal is often appearing when a wave 3 is within a wave 3, which is why it's one of my secret sauces, because it helps simplify the identification of them. So now let's try and do this one right here. Okay. This is going to be complex. I want you to try your best. Pause the video. Let me draw this structure here and see if you can identify it. Okay. So here, because this is going to best reflect what a regular chart looks like. So this would be your wave 1 right here. This would be your wave 2. As you can see, we have 3 lines here building into the wave 1. We then have a wave 2 here. That's a complex wave 2 because there's some choppiness there. And then we have a wave 3 right there. Then our wave 4. And then this would be our wave 5. And then if we wanted to chart the 5-wave cycle within the wave 3, that would be wave 1, wave 2, wave 3, wave 4, and then wave 5 right there. Right? Okay, so we had the 1 right here, the 2 right here, 3 up here, 4 right here, and 5 at the top right there. All right, so this is a 5-wave pattern, and in it, the strongest wave, the 3rd wave, also has a 5-wave pattern within it. And if you were trading this, if you could nail this move right here, that's where you're going to make the most money. Because this move, in this example, is shown a bit smaller, but typically this move is going to look something more like this move. It's going to be the biggest move within the pattern. So now let's get into some real examples. Now it's going to be so important when you're charting Elliot waves that you actually have the chart in logarithmic form. You can see the button here that automatically puts the chart in log form, right? So then it's important to do that because when you use your Fibonacci tools, you're going to want it in logarithmic form or your readings are going to be bad. And when you're charting your Fibonacci's, you might see that your chart doesn't look like mine. And that's because I've added 2 custom levels here at the 0.854 and 0.9. You're going to see a lot of alignments with these that you typically won't see if you just use the default settings. I also removed some bad levels that are really never applicable for Fibonacci's that TradingView defaults them to. And then you want to make sure that this box is clicked for Fib levels to display to be based on the log scale. Okay, so make sure everything's set to log and make sure you're charting in log for Elliott wave analysis because your default settings will not be set to that. Now for Tesla, we previously talked about how we could use the TTM to kind of be like an easy signal of what a 3rd wave is. So regardless of whether or not you remember that, we can clearly see that on the big moves to the upside, right here and right here, that we're likely looking for a 3rd wave, right? There's probably a 3rd wave present here. So the easy way, if we also click on this tool, we can do a default to a 5-wave pattern. We can see the big move here. We can go to the prior low and we can say, okay, that's probably my wave 1. So then how do you know? Well, wave 2 is pretty easy because we can say, okay, there's the retracement for wave 2. We can kind of measure the fibs and look at that. That's a beautiful touch right at our 618 right there. Most common retracement. Love to see it, right? Okay, now let's see if our extension, remember this isn't going to be exact, so we can see that it's obviously not a 0.618. Look how it blew right through it, right? Already we're seeing that there are some rules being broken here. But that's okay because an extension, let me try to make sure, let me try to get these levels just right because it doesn't need to be exact. So what this looks like is it looks like our 3rd wave went to the 2.618, right? And this gap up right through that level. If you're using Elliott wave analysis, use the TTM rule and you notice that they're getting the big move to the upside. You identify the 1st wave, you use the extension tool, you see this plow right through your 618, then you can start hunting for your 2.618. If it blew right through this level with no substantial retracements whatsoever, you could then look for the 3.618.
and it would help you stay into the trade or even plan for a big move like that into the trade. And I defaulted to this one as the example because this was actually my biggest trade this year, was into this move. And I caught pretty much all the upside here. Had some trouble with the fifth wave. And the reason for that is because typically with a truncated wave 1, you're going to see a truncated wave 5. And it is more prevalent when the third wave is above the 618, the 1.618 extension. So just some extra little rules there that are more on the more complex side, but are good to know. And we could also do some further levels here and see if the fourth wave obeyed any of them. And right there, you can see a perfect example of why we include these extra levels here, because the default tool would not have this aligned, and it would fake you out, make you think that you had done something wrong on your analysis. But that's a great example of finding a fifth wave, why it's important, how you can use the Fibonacci tools to help you stay into really big trades and catch those huge moves.